Hello friends, my name is Karun Nagpal and I am a valuer registered with Insolvency and Bankruptcy Board of India. In this video series, we are going to cover the entire course of IBBI Registered Valuer Examination, particularly for security and financial assets category. For those who are new to this area and not aware of the registered valuer, for them, the Ministry of Corporate Affairs have notified Section 247 of Companies Act, and through that section they have introduced the valuation rules 2017, and those rules became actually applicable from February 2019, and under these rules only a registered valuer can undertake the valuation required for Companies Act as well as IBC. If you want to know more who is the registered valuer and how to become the registered valuer, you can watch my other videos, or you can also visit the IBBI website. For those who wish to pursue this valuation as a profession, this is the right time to go for the examination, because the implementation of draft valuer bill is in pipeline, and soon there will definitely be a new regulator who will be regulating the valuation profession in India. Particularly in this video series, we would be covering the valuation examination syllabus in detail. I would like to start with the famous quote from Mr. Benjamin Franklin. He says, "An investment in knowledge always pays the best interest." So friend, in our first video, we will be discussing the topic finance and financial statement analysis that covers 6 marks of your syllabus. So let us start with the topic. First of all, we would be covering the basic concept of finance, which include time value of money, risk and return, NPV, IRR, payback period and all. What is time value of money? So let me take an example here. Suppose you have an option to get 1 lakh rupee at this point of time and the same amount after 1 year. The common sense would suggest you to go for 1 lakh now, because you will be able to use that money. Maybe you can invest that money in your saving account and you may earn something, or you may invest that money in somewhere in some fixed income securities or in your project. So that will fetch you some extra interest on that. So that is called time value of money. This is the founding principle of finance, that the money received at present is more valuable than the amount that would be received in some time future, and that future amount will also have some risk associated with that. Why time value of money is relevant? Because of uncertainty in future. Suppose a person chooses to receive a money from his friend after 1 year of time, so there may be risk that your friend may not be able to pay you money. So there is always a risk associated with that. His financial position may not allow him to pay back your money. So always uncertainty is associated with that. Preference for consumption. So suppose you have money, so your preference at this point of time will change. Maybe in future you may not have that preference. Suppose you want to consume that money to buy some fixed asset for yourself, and later on after 1 year you may not require that, so your preference may change with time. Available investment opportunity is one of the reason for the relevance of time value of money, because opportunity will not be always there at all times, right? They, at some point of time you may have some opportunity to invest some funds into some security. Some IPO is there, and you know that in future this the share price of this particular company will go up, so you may not have that option in future. And inflation is obviously one of the reasons. So money what you have at this point of time, you may not be able to purchase the same amount of asset in future, right? What you can have, you can purchase now, you may not be able to buy that for the same value in future. We have a formula here for time value of money. So future value is equal to present value multiplied by 1 plus interest rate divided by n is the compounding factor. Suppose compounding is half yearly compounding, then you will divide by 2, and in case of quarterly compounding by 4, and in case of monthly compounding by 12, and then raised to the power n into t. T is the time period and n is the number of compounding. So monthly compounding will have 12. Let us take this formula into an example here. Let's assume a person has 5 lakh rupee at present. He is willing to invest that money for 2 years at a rate of 20% interest, compounding half yearly. So if I put the above example in my formula, so future value would be equal to 5 lakh multiplied by 1 plus rate of interest divided by 2. Why 2? Because half yearly compounding. So half yearly interest rate would be 10% here. Raised to the power 2, 2 is the compounding factor, because each half year we would be computing the interest multiplied by 2. 2 is the number of years. So if you look at the table below, it says at zero period we have 5 lakh in hand, and first half year we will be able to earn 10% interest. It will become 5 lakh 50,000. Second half year it will become 6 lakh, and so on. After the end of fourth half year, that is after 2 years, we will have this amount. If you can compare this formula in Excel also, you will arrive at the same value. In the same way, we can also do compounding as well as discounting. Suppose if you have future value and you want to arrive at the present value, so you can use the discounting formula to arrive at the present value. Moving on to our next topic, which is net present value. In short, we will call it as NPV. NPV is used in capital budgeting and basically in investment planning to analyze the profitability of a project or investment. So net present value depends upon the interval of time, maybe because if you have a project with 3 years time frame and 10-year time frame, so your cash flow will be spread across that time period, and you may not be by just looking at the cash flows, you may not be able to determine which project is better for you. So that is why we compute the net this NPV. So this is basically net of cash inflows and outflows, discounted obviously. And for discounting, we use the discount rate. So discount rate is depends upon business to business. That is basically the weighted average cost of capital. So we will discuss about that in my coming videos. Generally, for treasury bond, we take the risk-free rate of return. So this NPV provides a method to the management to compare the various capital or financial projects, and because this, as I said, this cash flow is spread across and you may not be able to assess which is the viable project. So this is a tool which is used by the management. So in case we have a positive NPV, that means we can go with the project. In case of negative, obviously your inflows is less than the outflows. Then what are the advantages of using NPV? So this NPV accounts for the time value of money, because we are using the discount rate, and it takes into account all the cash flows, and inherent assumption of reinvestment is there in this method. So whatever you are earning, it automatically it is assuming that it gets reinvested, and it is a good measure for assessing the profitability of the project. Obviously risk factors are there, so it takes into account the risk factors either through cash flows or maybe through the discount rate. And some disadvantages, difficulty maybe in estimating the discount rate. Considering the COVID scenario, it is really challenging to assess the discount rate and cash flows, because uncertainty is there, and it is really a challenge to determine the future cash flow. Sometimes the investment cost, you may not be able to determine the investment cost at day zero, because maybe at later stage after investing, after spending a couple of years, you may come across additional investment which you may have to incur. So That is also NPV cannot compare the project with different sizes or different tenure. Why so? Because suppose if you compare a project with 5 lakh of initial investment with a project with 50 lakh of initial investment, so their inflow will be higher obviously, and the net present value would obviously higher for the project with the high size, right? Similarly with the tenure, if I talk compare a project with 3 year of life with 30 year of life, that will not be viable to compare, and NPV would not be able to give the correct solution. That is why we use another tool that is called internal rate of return. Basically, this tool is used to compare the projects with different time periods and with different capital requirements. So IRR is basically the discount rate at which NPV becomes zero. So it is a rate. So discounted cash inflows is equal to discounted cash outflows at this rate. What's the use of this, sir? As we discussed, there is a limitation of NPV because we were unable to compare the projects with different lifespans and with the different capital requirements. So that is why we use internal rate of return. So let us quickly understand the difference between IRR and NPV. So NPV determines the surplus of a project. So net profit of a project in terms of present value, whereas internal rate of return determines the break-even point with where we have no profit or loss. In case of NPV, we accept the project with a positive NPV, and whereas in case of IRR, we accept the project where IRR is greater than the required rate of return, and otherwise we reject the project. So in negative, in case of NPV, we reject the project. NPV tell us the absolute value, whereas IRR tell us the percentage terms. So moving on to the next topic, that is payback period. So payback period determines the number of years required to receive back your initial investment that we have made. So suppose we have invested 50 lakh rupees. So in how much time we will be able to recover our initial investment, maybe in 10 years, 5 years. So that is called payback period. Next one is risk and reward. That is again the principle of finance. Higher the risk and higher the reward, we must have heard of. But there is no guarantee as such, because the higher risk does not always equate to the higher return. It is just that the probability is higher in case of higher risk, probability of higher return is there. It is not necessary. Moving on to our next topic, that is financial decisions. So whether to go for debt or equity, your financial decisions, your investment decisions, whether to invest in securities or derivatives. So before taking the financial decision, we first need to understand why do business need finance at all. Businessmen need finance for setting up new business, for expansion, for regular bill payments, for working capital finance, for acquisition of other entities, for replacement of its capital asset, for internal growth, research and development, for its expansion, and there may be other reason as well. So basically we need finance, and when we need finance, we need to know how to manage the finance. Now, since we understand why do business need finance, now for finance we need to make the sound financial decisions so that we may not end up in a mess in future. And broadly, these financial decisions are divided into three parts: investment, financing, and dividend decisions. Under investment decisions, it will be either short-term or long-term decisions. Short-term would be for managing the working capital, for cash, receivables, inventory management. These all are short-term decisions, and the objective would be to maintain a balance between the profitability and the liquidity in the short period. And the long term would be the capital budgeting process. So here we have setting up of new plants, replacement of capital asset or major expenditure. These will be investments. So buying up some kind of treasury bonds. So some of the decisions are regulated by the regulatory bodies, and
Financial decision would be maintaining a debt equity mix. So how much debt, so that depends upon the your required rate of return, what return you expect. So you have to maintain a balance between debt and equity. You cannot go solely with debt or solely with equity. So to run a business, you will have to arrive at a debt equity mix. And then third one would be the dividend decision. So for dividend, whether to pay dividend or not, that solely depends upon your uh, profitability, your percentage. Suppose you being an organization, you are able to earn 30% in an year, and 12% is the shareholders expectation. So you should not declare the dividend in that case, because your profitability is higher. In case you are not able to meet the expectation of the shareholders, so better to distribute the dividends. Then next one is financial statement analysis. So before that, we need to understand the components of financial statement, why the financial statement is required at all. So that may be for regulatory purposes, for assessing the profitability, solvency, liquidity and all. And also for comparison with the other peers or doing benchmarking and all. And then later we will also talk about the various techniques of financial analysis. So what are the components? So components, as you all know, that income statement and balance sheet, cash flows are the basic components of the financial statement. So income statement represent the financial results from for a particular period of time, and balance sheet is the tell the financial position, and cash flow represent the sources and applications. So cash flow, we start with the net profit, make the non-cash adjustment, and operating, investing and financing activities, all the movements we adjust to arrive at the cash flows during that particular period. So this we are familiar with. Now the new is this got introduced through IFRS or Ind AS, the statement of change in shareholders equity or statement of change in other comprehensive income. So this is a statement of change in shareholders equity, depicts us the movement of shareholders equity, net movement in net profit and loss, increase or decrease in the revenue, payments through dividend and all. And other comprehensive income is part of all those shareholders equity. So some organizations show it as a different under different table. And OCI is basically where we do not want to take a hit on P&L. Suppose, for example, we have investment, and accounting standard says that we need to fair value the investment and report that investment at fair value. And at the same time, if we take the MTM to P&L, it will have the distorted picture. So we keep the MTM in the balance sheet, and we take that MTM to the OCI, other comprehensive. There are other components also, cash flow hedges, pension payments, or forex, foreign currency fluctuation, and as well we take into other comprehensive income. Then we have notes to account, so that presents a summary of our accounting policies, assumptions, explanation, and further the explain the balance sheet, income statement, line items. So for example, if I have in my balance sheet, if I have investment, so under notes to accounts I'll show investment, the classification of investment, the credit rating of those investment, the contractual maturity of those investment, and loss aging and all. So then we have management discussion and analysis. So here we talk about the financial, we do financial analysis of it, the performance of an organization. This is not though required by the regulators, but obviously shareholders want this, because under this section we discuss the profitability, how we are performing as an entity, what are our future strategies. Forward looking statement has a section in this MD&A. So we talk about various aspects of the business, various things in under MD&A. So these are broadly the components of financial statements. Then why do we need financial statement analysis? Why do financial statement analysis? For ascertaining the profitability, for analyzing the composition, whether we have a good asset mix or not, to determining the liquidity or solvency. So liquidity is short term, and solvency, in case you are not able to meet your contractual obligation, you may go insolvent. So to make sure the entity remains solvent at all times, so we have to do the analysis of financial statement. We do cash flow analysis. Suppose your debtors are increasing day by day, and you are not getting your revenues in the form of cash. So in that case, you may be in trouble. So for benchmarking also, we comparison with the other peers, other industry benchmarking, we do financial analysis. For investment decisions also, if you want to invest in some entity, you do financial analysis of that entity. Then there are various techniques of financial analysis. One of them is common size analysis, where we compare the balance sheet or income statement line item as a percentage of total assets in case of balance sheet, and percentage of sales in case of income statement. We do ratio analysis, we prepare the comparative statements, do trend analysis, cash flow analysis, and all. So this is the common size analysis. If you look at, so we have year 1 and 2, and we have comparison of 2 years, and we have taken the base as the revenue 100%, and direct cost is 50% of the total revenue. We have computed the cost in year 1, 50% is the direct cost. Then similarly, selling and other expenses 5% of the total revenue. So this is how we do common size analysis. Then we do comparative statement analysis. So here we do the comparative analysis in terms of absolute change in the value as compared to the previous year, or percentage change. Suppose 100 last year we had revenue, and this year we have 200, so 100% increase in the revenue. That is how companies show that their EBITDA multiple, EBITDA has gone up 140%, like this, because earlier year 1 they were 25 and now 60, so 125 140% increase in the multiple. Then we do ratio analysis for assessing the performance. We do cash flow analysis. We have ratios there: interest coverage, dividend payout ratio. For capital structure analysis, we have liquidity ratio, current ratio, quick ratio, cash ratio. Profitability, we have GP margin, operating margin, return on investment, leverage ratio. We have debt to asset ratio, long-term debt to capital, time in interest earned. So similarly for valuation and growth, we have EPS P ratio, and then we have Dupont model, that is one model developed by one big company. So let us discuss all these ratios in detail. Cash flow coverage ratio. So interest coverage ratio, we have under this ratio we try to compute the company's ability to honor its debt payment. So we take the cash flows, operating cash flows, plus interest paid divided by interest paid. So whatever we have divided by the interest. So we try to compute the capability of debt payments. Debt coverage ratio. So this is again used to measure the entity ability to produce cash to pay its debt. And dividend payout ratio. So how much is paid to the shareholders and how much is left. Dividend payout ratio tell us. Debt payment, operating cash flows divided by cash debt repayment. So this ratio, debt to income, is used to compare the cash flow that goes toward debt payment. So operating cash flow, we have total cash flow divided by cash debt repayments, how much we have paid. So percentage of cash flow that goes toward debt repayment. Similarly, investing and financing, operating cash flow divided by cash outflow from investing and financing activities. Cash flow performance ratio, we have operating cash flow divided by revenue. Similarly, cash return on asset, operating cash flow divided by average total asset. So my idea of sharing this is you will have to understand all these ratio, because in the examination they will ask you, they will pick any of the ratio and they will ask you the other leg of the denominator or numerator of this formula, and they will give you 4 options to choose from. So similarly, liquidity ratio, we all are familiar with current ratio, quick ratio, cash ratio and all. Current asset, these are pretty commonly used. And profitability ratio also we commonly used, such as gross profit ratio, GP ratio, so GP upon sales, these are sales ratio. Then we have net profit ratio, net profit divided by sales, EBIT divided by average total capital, return on capital, return on equity, net income divided by average total equity and all. Activity ratio, some of the activity ratios are receivable turnover ratio, annual sales divided by an average receivable, so that is receivable turnover ratio. Similarly, asset turnover ratio, revenue divided by average total assets. Solvency ratios, we have total debt to capital, so long term and short term, total debt divided by capital. Financial leverage ratio, asset average total assets divided by average total equity. Similarly, coverage ratio, so interest coverage ratio, fixed charge coverage ratio. So these are all common sense. You would have to just go through, you will understand by these ratios, by going at looking at the ratio, you will be able to assess. Then we have the Dupont model. So Dupont model analysis help us in analyzing the return on equity. So return on equity, what it will do, it will break down the return on equity into various parts, and it will reach out and it will show that it is a multiple of 3 different ratios. Let's see how. So return on equity, we know that net income, that is net income divided by average equity. Now what we have done, we have divided the net income and average equity by revenue. So net income divided by revenue and average equity divided by revenue. We have flipped that. That is why you see a sign change here. Then we further divide it by average total asset. So net income by revenue is 1, then revenue by average total asset, then average total asset by equity. Then net income divided by revenue is net profit, revenue divided by average total asset is asset turnover, average total asset divided by equity is financial leverage ratio. So this formula shows that this is a multiple of these 3 ratios. Return on equity is a multiple of net profit margin, asset turnover and financial leverage. The last one for today is credit analysis. So this is used to assess the credit worthiness of an organization. So the 3 factors of credit analysis are character, collateral and capacity. So character determines the reputation of an organization. I may not be able to compare Tata with some another organization because their reputation is different. They have a past history. So that is one, reputation. Collateral, second one is ability to pledge. So if you have ability to pledge something, you have a very good asset base, such as Apple. Apple is a cash rich company, so you can pledge and you can easily get loan, so your credit rating will get improved. And your capacity to repay, whether you would be able to repay your debt or not, so that will determine your credit rating. What would be the consideration for credit analysis? So first one would be the scale of operation. So company which have diversified operations, basically large companies, would have better credit rating. Then the operation efficiency. Companies with better operating margin, companies which are earning huge, maybe above the industry trend, may have a good credit rating. Then the leverage. So leverage is something company having better earning in relation to debt and interest payout. Suppose you are earning 50,000 and your interest and debt is just 10,000, you are earning 5 times higher than the your interest and debt payment. That means you are sitting at a good leverage. Then the stability of margins, so your margins are better than the industry and that are continuous, so that these all are the factors for a good credit rating. That's all I have in my video. So thank you for watching and stay tuned for my next video. Thank you.